Trump signed the One Big Beautiful Bill, and it changed my taxes forever. Trump signed a new tax law on July 4, 2025. Most Americans have no idea. What did the One Big Beautiful Bill actually change for you? Which brand new deductions can you claim right now? And who actually wins and who quietly loses under this law? I did not know how much had changed until I filed. I have filed my own taxes for years. Basic software, answer the questions, submit. When I sat down to file my 2025 taxes in early 2026, I expected nothing unusual. I was wrong. The One Big Beautiful Bill signed into law on July 4, 2025 had changed more lines on my return than any tax law in my adult life. Some changes put money in my pocket. Some cost me money I never saw coming. And several brand new deductions I had never heard of were sitting there unclaimed. I am going to walk you through everything I found so you do not miss what I almost did. There are more new deductions in this law than any tax legislation in the past 8 years. Most are not being advertised anywhere. By the time most filers realize what changed, the best deadlines have already passed. I am going to make sure that does not happen to you. What the One Big Beautiful Bill actually did. Here is the simple version. Trump's 2017 Tax Cuts and Jobs Act had always been set to expire at the end of 2025. That meant if Congress did nothing, your tax brackets would have reset to the higher 2017 rates starting January 1, 2026. The One Big Beautiful Bill stopped that from happening. It made most of the 2017 cuts permanent and added new ones on top. Signed on July 4, 2025. Independence Day. Public Law 119-21. Already changing your return. Some changes took effect for your 2025 tax return. Others kick in starting with your 2026 taxes. Both years matter. And most people I talk to have no idea which is which. Let me break down what actually changed in plain English, starting with the things that put money back in your pocket. The standard deduction just got bigger. Again, the standard deduction is the amount you can subtract from your income before calculating what you owe. The 2017 law already doubled it. The new law made that larger amount permanent and increased it further. For your 2025 return, the one you filed in early 2026, the standard deduction is $15,750 for single filers. For married filing jointly, it jumped to $31,500. That is $1,500 more than 2024 for married couples alone. In 2026, the numbers increase again, and they will keep increasing automatically every year after that. What this means practically, the majority of Americans who take the standard deduction will pay taxes on less income than last year. Not because they earned less, because more of their income is automatically shielded. That is a real dollar benefit even if you never itemize a single thing. No tax on tips. What it actually means. This was the headline policy Trump campaigned on in 2024. It is real. It is in the law. But it is more complicated than the campaign slogan made it sound. If you work in a job where tipping is customary, wait staff, bartenders, baristas, salon workers, delivery drivers, you can now deduct qualified tip income from your taxable income. It runs from 2025 through 2028. Temporary. Use it while it exists. To qualify, your adjusted gross income must be under $160,000 as a single filer, and the tips must come from a job in an industry the IRS officially designates as tip qualifying. For millions of service workers, this is a meaningful and real tax cut. For others claiming they qualify who do not, the IRS is watching closely. No tax on overtime. The deduction most workers are missing. This one surprised more people than any other provision in the entire law. If you earned overtime pay in 2025, up to $12,500 of that overtime income is now deductible. For married filers, the deduction goes up to $25,000. It phases out if your income exceeds $150,000 as a single filer or $300,000 jointly. But for most hourly workers, this is real money. A nurse working overtime, a factory worker on mandatory weekend shifts, a truck driver running extra routes. These workers paid full income tax on every overtime dollar last year. This year, up to $12,500 of that money is tax-free. It is temporary, it expires in 2028. But for the 4 years it exists, it is one of the most direct middle-class tax benefits in the bill. By the way, if you are getting value from this, hit that like button and subscribe right now. And if you are serious about fixing your credit and getting funded in 2026, grab my book, Credit Rewrite 800 The 800 Plus System, and get funded for your business. The link is in the description. Everything you need to get approved and get started is inside that book. The SALT cap jumped to $40,000. Who that actually helps? The state and local tax deduction, called SALT, was capped at $10,000 under the 2017 law. That cap hit hardest in high-tax states like New York, New Jersey, and California, where property taxes alone could exceed $10,000. The One Big Beautiful Bill raised the SALT cap to $40,000 for tax years 2025 through 2029. For homeowners in expensive states, this is a significant change. There is a catch. The higher cap phases out for taxpayers with modified adjusted gross income over $500,000. And the $40,000 cap reverts back to $10,000 in 2030, unless Congress acts again. Still, for the next 4 years, millions of itemizing homeowners in high-tax states will see a real reduction in their federal tax bill. If you own property in a high-tax state, and you have been itemizing, recalculate your deduction with the new $40,000 limit before you leave money on the table. Who actually pays more? The part nobody is advertising. I want to be honest about this because the bill is not a universal tax cut. The enhanced premium tax credit that made ACA health insurance affordable for millions of Americans expired at the end of 2025. The One Big Beautiful Bill did not extend it. The Tax Foundation and the Institute on Taxation and Economic Policy both estimated that in 2026, the average American in most income brackets is paying more in total once tariffs, expiring credits, and the new law are combined. Tariffs alone are estimated to cost the average household $600 to $800 this year. If your ACA health insurance premiums went up in 2026 because the subsidy cliff is back, that is a direct cost of this law not extending those credits. The tax cuts are real, so are the costs that offset them for many families. Know which side of that equation you are on. The new car loan interest deduction. This one is brand new, and most people filing in 2026 are missing it. If you took out a new car loan in 2025 on a vehicle assembled in the United States, you can deduct up to $10,000 of the interest you paid. The deduction phases out if your income exceeds $100,000 as a single filer or $200,000 married. It runs from 2025 through 2028. And the vehicle must have its final assembly in the United States, which directly ties to Trump's broader tariff and trade policy. Not every car qualifies. Check the IRS list of qualifying vehicles. But for middle-income buyers who financed an American-assembled vehicle, this is a deduction that did not exist 1 year ago. If you financed a car in 2025 and never heard of this deduction, you are not alone. Most people have not. Check whether your vehicle qualifies before you file. Action steps. Today, check whether you received overtime pay in 2025. If you did, and your income is under $150,000, you may be able to deduct up to $12,500 of it. Today, if you work in a tip qualifying job and your income is under $160,000, verify your tips were reported and check whether you can claim the qualified tip income deduction. This week, if you own property in a high-tax state and you itemize recalculate your SALT deduction using the new $40,000 cap instead of the old $10,000 limit. This week, if you financed a new vehicle in 2025 assembled in the United States, Check whether it qualifies for the new auto loan interest deduction of up to $10,000. This month, if your ACA health insurance premium increased in 2026, calculate the full annual cost increase and factor it into your tax planning for the year. The One Big Beautiful Bill is the most consequential tax law change since 2017. Whether it helps you, hurts you, or does both depends entirely on your specific situation. Tell me in the comments, which part of this law surprised you the most? Next video. The Iran War started February 28, 2026, and it is adding a hidden tax to your grocery bill, your gas tank, and your entire cost of living that nobody in Washington is calling a tax, but economists definitely are. Subscribe, that one is coming this week. Subscribe, hit like, share this with someone who has no idea any of these deductions exist. Wait, don't forget to check the description below.